Hello, in this presentation we will record an advanced payment from a customer within QuickBooks Online. Here we are on the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to be recording a payment from a customer, but it will be an advanced payment from a customer, meaning we're going to get paid before we do the product or service. In this case, giving the product, we're selling guitars. Therefore, we're going to get a payment before we give the guitar away, and that means that we haven't earned the revenue at the point in time that we got the money. This is a little bit more unusual of a transaction. Not all types of companies will have this type of transaction because normally the process would be that we get paid at the point in time that we do the good or service, or at a later point in time, not typically before. But certain industries we do get paid before many times. With the case of a guitar or something like that, we may be asked to hold on to the guitar and therefore get advanced payment in order to do that, for example, and then provide the guitar later. Something like a concert where we sell tickets before the concert actually happens should go into some type of unearned revenue, as we will show here. We'll have a similar situation, in other words, as we will show here. So to do that, we're going to select the plus icon up top, and we're looking for the customers section over here, and we will have the receive payment here. Funny thing about this is it's not going to go through the normal flow. The normal flow for customers would be that we either have an invoice and then we receive the payment at a later point in time in the mail, or we have just a sales receipt, at which point we made the sale, gave the guitar away, and got paid at the same time. What we're going to do is use the receive payment, which is usually what is used after an invoice, but record it before we actually have the invoice. That's what's going to be a bit unusual. When we select receive payments, we have this screen here. Receive payments means that we've got some type of money, and that typically will increase some type of cash type of count. This one's going to increase the undeposited funds until we deposit it into the bank. We're going to say that Anderson Guitar gave us some money. The scenario is going to be that they gave us $250 at this point in time, and we did not yet give them a guitar. What we did is we said we're going to hold on to the guitar for a later point in time. So they gave an advanced payment. The $250 will be going towards the guitar that we will provide at a later point. At this point in time, no invoice has been made because we have not yet given the guitar, and the $250 we're getting, we really haven't yet earned. So we're going to say that Anderson Guitars, we could select the drop down and or type in Anderson Guitars, and it will populate for us. We then have kind of an error signal here. It's saying, Anderson Guitar payment doesn't have an open invoice. So if that means that there's nothing to link it to, typically when we have a received payment, we will have some type of invoice that we will just check off and click on down here. At this point in time, they're saying, hey, you're getting a payment for what? You didn't do anything. You haven't given a guitar. You haven't done any service. Why are you getting this payment? And so we're gonna say, well, that's okay because we got the payment before we're going to record the invoice, which is, once again, a bit unusual. So we'll tab through this, and we're going to say that this is 02/16/21 is the date. We're going to be working in February 16th, 2021. Note, when I say that it is unusual, by the way, it's under the usual for most types of companies. It could be a normal transaction for certain types of companies, such as if we have a concert or if we sell magazines or any type of subscription service these days. Those are all types of businesses where we get paid before we provide the service, and we will have a similar situation with those types of industries. So we're going to say here that the payment method, I'm going to say that it is a check. So I'm going to say it's a check that we got. And we're going to say the check number is 5243. It's going to go into undeposited funds. We're not going to put it in the bank. That's just the same as normal. We're going to group them together and then put them all in the bank at the same time. The amount then we're going to say is we got $250 as the down payment on one of the guitars that we will later be recording. And that's going to be it. Note there's no other invoice that we have here. So what is going to be the journal entry here? A little bit different than possibly you may be thinking from a theory type class, which you would say we got a prepayment, we got money for work that has not yet been done, which means that cash would go up. Cash is kind of going up, but it's undeposited funds. It's not going in the checking account yet. And the other side typically wouldn't be revenue because we haven't earned it. It's not going to go into revenue, and it should go into a liability, undeposited fund. A liability called unearned revenue, typically, or some type of unearned liability type of account. Note that the receive payment option here, though, typically means that we're going to reduce a accounts receivable account. So a receive payment form typically means accounts receivable will go down. Problem though, accounts receivable doesn't have anything in it related to an invoice for Anderson Guitars, and therefore when we bring the accounts receivable down, what we end up with is a negative receivable, meaning it looks like we owe Anderson Guitars, which we do. We owe either the $250 back or we owe them the guitar in the future. So that shouldn't happen. We shouldn't have a negative receivable. We should have a liability that's going in the liability direction, not a negative receivable. This works really well for QuickBooks, however, because the negative receivable allows us then to create an invoice, and the invoice will match up against that negative receivable, meaning the subledger that we track this negative receivable in by customer, Anderson Guitars, will work great in this process. However, until we match it up, it's not quite right. So if we make the financial statements as of the point in time that this is still outstanding, we'll have to do an adjusting entry, as we'll see, to really kind of correct the fact that we're creating a negative receivable instead of a positive liability. So this is one of those areas where functionality, logistically, this works quite well. Not exactly correct in terms of GAAP or generally accepted accounting accrual principles, and we'll see that in the adjusting process. So let's save this and then take a look at it. We'll close this back out. We're going to go to the reports left side. We're going to go to the balance sheet. I'm going to say balance sheet and open up the balance sheet and change the dates to the month of February 02/01/21 to 02/28/21, February 1st, 2021 to February 28th, 2021, and run that report. Then if we scroll down in the undeposited funds, we see that 250, that's where we put the funds until we go to the bank. There it is there. There's the 250 that we put the funds until we go to the bank. And here is our receive payment item. Closing that out, scrolling back up, going back to our report, back to the balance sheet. The other side then is not in a liability account called unearned revenue, as it should be. It shouldn't be in revenue because we haven't earned it, but it should be in some type of liability typically. We put it, however, into the receivable account, which is $965. If we look at the detail there, then we see the 250, that's a negative. It's bringing the receivable down. However, even if we go back to the prior month, if I go back and I change the date range here to January 1st, 2021 to February 28th for this transaction detail report and run that report, we don't see anything matching up against that 250. What we should see is the account going up like this and then going back down. That should be the typical trend we see when the receivable goes up and then it goes back down. Here we have this going down and there's no corresponding increase prior to this. And that's what's unusual. So note the receivable is still positive. It's not like it gave us a negative receivable in total, but the receivable should be 250 higher and we should have a liability of 250 rather than having the receivable decreased by this 250 here. To see this more clearly, let's look at another report, which will be a report by the receivable report by customer. So we're going to go to the reports left side. We're going to go to the customer balance detail. We would like to see the customer balance detail report. We will select that report and run that report, customer balance detail. And what we see here when we run this report is we see the same total, $965.27. However, if we break this out by customer, Jones looks normal. We got $399 owed there to us. They owe us $399. Music store stuff owes us $816. And then we have this negative receivable, meaning it kind of looks like we have a receivable in which we owe them $250, and that's what it means. because we owe them $250. We're not going to give them $250. We are hopefully just going to give them the guitar to complete the transaction that we have started by them giving us a down payment. However, it shouldn't be that we owe someone something in the receivable. It's an asset. The fact that we owe somebody else means it's a liability and should be in the unearned revenue. So this works great logistically because once again, once we have the invoice for Anderson, it'll match up to this amount and this subledger, this customer balance detail will be correct. However, until that happens, it's not quite right. So it's going to be just one of those little quirks that logistically works well. You see this a lot in practice. You won't see it so much at all in a theory kind of book, textbook.